Portfolio, October the 8th, 2015. I'm Alec Hogg.
And I'm Stuart Lohman.
And we're in the Biznews studio here at the Johannesburg Stock Exchange to bring you up to date with what's been happening with our portfolio in the last month and a bit. And the reason why we're a little bit later than usual is I spent September in the UK, in London, going around meeting very interesting people. You've lived in London, Stuart?
Yeah, I spent a couple of years there straight out of school. So interesting place, lots going on.
And exciting as long as it isn't winter.
Exactly.
Yeah. Well, there was a lot of sunshine, and that was good. Coming home to the sunshine here in Johannesburg with the best weather in the world. Well, you know, who can get it wrong? Okay, I see we are now ready to start kicking off and getting into our global share portfolio for the past month. So this is the September update. We're going to have another update later in the year, of course, in the month rather. But this is the one that we should have done towards the end of last month. We'll do another one towards the end of October, and of course, let you know all about that. Let's go straight into the portfolio. That's what you will see in your Standard Bank web trader account. It's exactly the same as this, an account summary. It shows you how the portfolio or the money that's in the portfolio at the moment. We started with $200,000. It's $210,000. So you can work that out. It's a 5% increase in our portfolio over the past year. I'm very proud of that because the market as a whole is down by 3%. And as you well know, beating the market is not an easy task at all. We've managed to do it. And then we'll move on to the other account overview, which you will have as well in your Standard Bank web trader portfolio if you are if you have opened an account. If you haven't opened an account, I urge you to do so because it's very, very easy to replicate our global share portfolio. And of course, by tuning into the webcast every month as when we broadcast it, or you can even listen to the recorded version a little later on Biznews, you can keep up to date. So if you like, you've got your own portfolio manager giving you the reasons why we've made these investments and then also updating how they've performed in the past month. Remember, though, this is not a portfolio that we trade. This is a buy and hold for keeps portfolio. It doesn't mean that the constituents of the portfolio will never change. Indeed, if we do find a couple more good stocks to include, and I've been looking at a few. I haven't yet found one worthy of inclusion, certainly not through my own research. We would then sell some of the Vanguard S&P 500 ETF and then invest that into a different stock. But we'll give you more information on the individual stocks. How we've structured the portfolio, you can see that Vanguard is around about 30%. Let's just go to the next slide. That's a far better way of explaining it. If you look on the far right-hand side, you'll see that there's a target there for Vanguard of 30%. There's a name called Alphabet that might have thrown you. Please don't worry about it. It's Google. Google has not changed its name to Alphabet. And with 56 shares, I think we go up to 56.15 shares or something. If you had 350 shares, you get 356 shares in future. So we've got a tiny little increase in it. I'm not worrying about that for our purposes because this really is more of a reflection. But the idea was to have 30% in Vanguard, 15% each in two stocks that we regarded as our cornerstone stocks, and that's Google, or now Alphabet Inc., as of, in fact, I think the beginning of, from the beginning of October, from last Friday, and Berkshire Hathaway. Those are our two cornerstones. And then the idea was to have another 5 stocks, which would be stock picks. So each of them would have 8% shareholding. I like Apple so much that after buying the first lot of Apple shares and seeing the share continue to fall, I bought another lot of Apple shares. So we have Apple now as one of the cornerstones of the portfolio as well. And as you can see, in fact, it's got a target there of 16%. That's not because we thought Apple was better than Google or Berkshire, but it's because we had the 2 lots of 8% in stock picking, which we've put into Apple. And then the other 3 shares rather, Amazon.com, Novo Nordisk, and IBM. If you have a look at this column, because although we do say to you that you should not be worrying too much about the short-term movements in the share price, these are stocks that we've held for keeps, it will show you that the Vanguard S&P 500 is down by 3%. since we began the portfolio, which was in the beginning of December last year. So we're 10 months into the portfolio now. That is the overall market. Vanguard is a exchange-traded fund that tracks the S&P 500 index. Then if you look at the other stocks in there, this is in US dollar terms. It's down 3%. Google's up 20% in US dollar terms. Apple and Berkshire both down 11% in US dollars. And Amazon.com up by 65%. Clearly our star performer in the portfolio. Novo Nordisk has done pretty well as well, 18% up. And IBM is 8% lower. If you just put it all together, and the reason why we encourage the investment of money into the international markets is because towards the end of last year, we took a view here at Biznews that this economy, the South African economy, was being managed in a way that the currency or the share price of the economy was likely to continue sliding certainly in the near future, until such time as economic policies here become more rational. As a consequence of that, together with our sponsor Standard Bank, we decided to launch this portfolio as a guideline for anyone who shares our view, and then we suggest that you take rands and put them into the web trader. It's very easy. In South Africa, you can invest in the dollars through the web trader. In fact, you can invest R1,000,000 without even having to talk to your bankers on this one. What has happened to date in those 10 months is that the US market is down 3%. We're up 5% in US dollars, but the rand has fallen 20%. So in essence, our portfolio overall is 24% higher in rand terms, and the constituents, the winners have been Amazon, which has added more than $10,000 to our portfolio, Google $6,000, Novo Nordisk $3,000, and we've had dividends of $2,500. So if you like, pluses are $22,000, minuses are $10,000, and that's through Apple and Berkshire, about just over $3,000 each. The market as a whole down about $2,000, and IBM down $1,200. So from the $200,000 beginning, that is, if you like, the way it's balanced out. Amazon, Google, Novo being the big winners, and Apple and Berkshire the big losers, with both Vanguard and IBM just trickling a little bit of money away there. But being a South African, the important part of this portfolio is that it is a rand hedge, and even if we were just tracking the S&P 500 index, given that the rand has fallen over this period by 20%, you'd still be looking at 17% gain. So you really, all you had to do was follow that decision that we took, or the view that we took, which was that the South African economy was being managed in an irrational manner, which was not going to assist the exchange rate, and you would have now been looking at a pretty positive, or certainly a far better situation than had you invested the money into a bank account locally. Looking through the rand value, it's quite extreme. Add the 20% to Amazon.com, and you've got a 98% gain in that share price over the past 10 months. 44% for Google, 42% for Novo Nordisk. Even IBM, which was down, is up 11%. Even the market as a whole is up 16%. And the only loser in all of this is Apple. Okay, you can maybe blame that, call it Alex Folly. But I'd still believe that we are going to have pretty good value from Apple in the medium term, and we'll go into more details in a moment. The annualized return on the portfolio is 29%, a figure which is very satisfying. But do remember, even if it was 2%, we would still be talking the same language, because this is a long-term portfolio. We're not talking about trading, and please don't go and sell these shares now because you've made an annualized return of 29%. It is something that the money should have been invested, and you just let it ride. That's what it's about. But Warren Buffett from Berkshire Hathaway says the period to hold a share is forever. We agree. Dividend receipts over this period. We actually got in August, on the 6th of August, $534 from Apple Inc. So it isn't quite as bad as it looks, and the decline there in that share price. And the other dividends are as they were before, excepting with the Vanguard S&P, they pay dividends quarterly, 95 US cents, which earns out to about $300 on our investment there. let's go into the individual constituents, because this is where it gets interesting. In fact, before I forget, Stuart.
Yes, Alec, we're still waiting for some questions. We'll answer whatever's thrown at us.
How do we do that? How do we ask questions? It's just on the screen.
Yes.
Tap it in.
Tap it in on the right-hand sidebar. Send it in. I'll read it out, and then we can answer them as they come. So
okay. We had lots of questions last time, and in fact, I found it a bit difficult to even get through everything I wanted to say in our half hour last time around. So if you've got questions, it's a good idea to bring them up as soon as possible so that Stuart can interrupt me, and let's go through it. Okay, this is the S&P 500 index tracker. Why we went with this Vanguard stock is it has a very low cost. In fact, the costs here are 5 bips, or 1/20th of 1%. Now, how do they manage to run a portfolio with such a low cost? Well, what they do is they take the S&P 500 index constituents and invest in weightings in exactly the same way as they are weighted in the S&P 500 index. And because it's such a huge portfolio, this Vanguard index tracker, they can also lend out the shares that they've owned, or that they own in the portfolio, to those players who want to go short on particular funds, on particular shares rather. So they earn money in, does Vanguard, and then offsets that against the cost of trading, and that's how you get to such a terribly low cost. So the index tracker, as you can imagine, you look at this here, it is just about it's a very close correlation between the two. I was going to say just about 100% correlation. Of course, that's not correct. But the overall index, since we began, down around 3%, 2.81%, and that is the index tracker is in line with that. The market as a whole took an awful knock, as you can see, during the period at late August, early September, and that has been well documented. We are, however, back in a more positive territory. An awful knock in this case was about 10%. We're not concerned about the US market. We would have been terribly concerned if we were invested in China, but we haven't invested in China. So if you consider that the fallout in China and the way the reverberations came across the world, the impact on our portfolio has been fairly minimal. Moving on to Berkshire, one of our 3 now cornerstone shares. Quite often the questions in these webinars come up requesting whether you can go into the portfolio now and replicate it again. I do feel that some of the shares have run really hard, and it's quite obvious when you have a look at them which those are. But on the other hand, there's also a great opportunity on some of the shares that have lagged, and Berkshire is one of these. In the past month, Warren Buffett reiterated a view that he expressed at the annual general meeting in May, where he started getting some concern about reinsurers. They're a big investor in reinsurers, or Berkshire Hathaway, around the world, and he is, in fact, the biggest investor in Munich Re. They cut their holding in the past month from 12% to just under 10%. Berkshire is still the biggest shareholder and still got 41 billion rand invested in Munich Re. But Buffett in May said he was a little concerned about the way that the reinsurance market was pricing, and he believes that the industry in the next 10 years is going to be a poorer performer than it was in the last 10. So as a consequence, he's moving out of reinsurance. And that's really the only bit of news that came out of Berkshire Hathaway in this period. You'll see that it also fell, as did the US stock market, when you had the fallout from China. And it's just like the US stock market, continuing now to stabilize and down by around 11% from when we bought in, which is an underperformance of 8% on the market overall, and has had a little drag on our portfolio, but we're very happy to have Berkshire as a longer-term bet. On to our next stock, which we still have. It still has a logo of Google, but actually it's called Alphabet, not Google anymore. So we'll update that graph next time around. But as you can see, it's been a superb performer, but a bit like Berkshire Hathaway, underperformed for much of the past year. And then the transformation came just ahead of our previous webinar. I went into a lot of detail about what happened there. In essence, just to summarize for you, the market really enjoyed the quarterly results that were out. Well, as you can see, the share price shot up from being an underperformer to up around about 25% in a very short period of time. And it's stabilized at that level. It's now up 20% in dollar terms, remember, over the past 10 months. And we're very comfortable to hold our position there. Alphabet could unleash a lot of energy within the whole Google organization. What they've done is split up the business into the main search engine and then other subsidiaries that are being built in a way that they're hoping will one day even surpass the size of the search engine. A big bet is being made on driverless cars, and Google in this past month hired the former head of Hyundai in the United States, who'd been very successful in building that business. He's now the head of driverless cars at Google. Interesting to note that it's Google and Apple are the two who are making most of the headway in driverless cars. We know all about Google because they were very open. We know nothing about what Apple's doing because they've kept it extremely secretive. But on the other hand, we're now also seeing the major motor manufacturers coming into this market as well. It's got massive implications into the future when you have motor vehicles that don't need you to drive them. Can you imagine what it does to insurance rates, what it does to fatalities, what it will do to just general living standards, and reduce an enormous amount of wastage, as at the moment cars stand idle. Most cars stand idle for most of their lives. Driverless cars would be a little bit like Uber, coming in, disrupting the current industry, and these are the disruptors, Alphabet or Google and Apple. The other bit of news that came from Google in this past month, or this past 6 weeks since our last webinar, was that it's now moving aggressively into the news front. It's already got Google News, but there's the boxing with Facebook and Apple, or between Google, Facebook, Apple, and if you like, Amazon.com, is now heating up, and they're fighting each other in various areas. These guerrillas are leaving very little ground available for other players, and between the four of them, those four, you're seeing the markets developing quite rapidly. They compete in certain areas and they leave each other alone in others. One of the areas where they're competing a lot is in the news field. They have introduced, Google have something called accelerated mobile pages in the last 48 hours, bringing in publishers like the BBC, The Guardian, the Financial Times of London, Twitter, LinkedIn, and in that way wanting to speed up this whole news service on mobile phones. It's an interesting development on that side. The other place where they are boxing is against Apple on the mobile phone area. Google have also recently launched their upgrade of a mobile phone, and they have also announced that they will be working with Huawei of China, who's also one of the companies they don't like too much, or hadn't in the past. They're going to be collaborating, though, on a new mobile phone to take on Apple's iPhone 6s, which, in fact, was the biggest development of the whole portfolio in this past month, but I'll get into that in a moment. We're very happy with Google. We'll stick with it. Amazon.com, which is our best performer by quite some distance, has continued to attract a lot of interest and attention from investors. As you can see, it's really had a wonderful run, and it's almost like every time there's a set of quarterly results, you can see that just before, or rather the end of January, you can see that again in April, you can see that again towards the end of July. There has been a big move in the share price. Amazon did come down during this period, knocked by the global market decline, but it's bounced right back, and in fact it's getting close to all-time highs again, up 66% since we bought it. Just to remind you that we are open for questions, so if you've got anything and you need a little bit of elaboration on any of the issues, please do drop that, just type it in, and then Stuart will pick it up and stop me, and we can attend to your question immediately. So that's the story of Amazon. In this period, it started moving more aggressively into the Internet of Things. What that is appliances. just normal day-to-day stuff that is connected through the internet. And they've put together a deal on with a number of manufacturers where these appliances are now also getting so smart that they reorder what they need. For instance, washing machines, General Electric washing machines. When the washing powder or the softener starts falling to a level where it needs replenishment, automatically in the United States, it'll send a order, if you want it to Amazon, who will then deliver to you washing powder and softener, which will then get put into the washing machine. It's an incredible, you have to almost open your mind. It's mind-blowing in many ways what the Internet of Things means. But if anybody is well positioned, given that it's got these links into manufacturing and it's got the delivery capability to benefit from the Internet of Things, it's Amazon. Another area where Amazon is also way ahead of the field is in the cloud. It got involved in Amazon Web Services many years ago. Everybody else was a little bit slow to react, and today Amazon has got a huge advantage in that field and continues to make great strides in dominating a very important area for the future. You might remember in the last webinar we spoke about Amazon exceeding Walmart for the first time in terms of its market cap. Well, the enterprise value, which is a more important determinant for most investment managers, has also now exceeded the market cap of Walmart. So it isn't just up there as an airy-fairy thing. The enterprise value of Amazon.com, which basically discounts the cash that they have on the balance sheet and includes the debt that they might have in both companies' case, is now exceeding Walmart's. It's sitting at about $250 billion. Extraordinary success story, and one that we've had a wonderful run from. Remember, this is in a portfolio where you hold on for keeps, so we are not in the business of selling, and don't be tempted if you followed us into it. Moving on to the next one, Big Blue, IBM. Its performance against the S&P 500 has lagged a little, not too badly. It's only, what's that, about 4% worse than the all-share index, and not a bad thing if you listen to what Warren Buffett is saying. He's the biggest shareholder now in IBM and continues to buy the stock. IBM itself is buying its own shares back. And if you can buy your own shares back at a lower level, in other words, apply your cash to buy your own shares cheaper than if the share price had run, then surely for the business, it's a good thing. Maybe for the investors who are trying to make a quick turn, they would criticize it, but for the business as a whole and the long-term benefit of the business, it is a very good thing, and IBM continues to do that. We're very happy with this as a value play. On to Novo Nordisk. It is beating other pharmaceutical companies in the rush back into Iran. You might recall that Iran had a nuclear program that the Americans didn't like at all. So as a consequence, they had sanctions against Iran. This was something that didn't bother the South African company MTN too much, and MTN went into Iran and has got a very strong position there, although it did bring all kinds of accusations that the management had bribed people to get the license in the first place. That seems to have been quietened down in MTN's case. Novo Nordisk, which is the world's biggest supplier of insulin, had to wait until things got better. They do have a manufacturing capability in partnership with a local Iranian company, and in fact they supply insulin for 700,000 diabetics in Iran as it is, but they have announced in the past month they're going to be spending 70 million euros to build a new factory in that country, the first Western pharmaceuticals company to say that it's going ahead. So good news for the Iranians that they are at least seeing some dividend coming out of their decision to change or to open up their nuclear program, and good news for Novo Nordisk shareholders that they are have the first mover advantage into another very big market. On to Apple, because this is going to dominate the rest of our conversation. It was the month of the launch of the next big thing for Apple. Apple iPhones are an important part of, not important, they are the major part of the company. 56% of sales come from iPhones. Last year they sold 169 million units. And the concern with Apple, and you can see the drop in the share price over the past 3 months, has been that the iPhone 6 would not live up to expectations. And if the iPhone 6S, which is the new one that was launched, if that didn't do well, or if it doesn't do well, investors worry that more than half of Apple's sales are riding on the back of its iPhones. It would then have an implication on the share price overall. This is a stock that's only trading at a price to earnings ratio of around 12. It's sitting with about a third of its market cap in cash, and it has a wonderful brand, as you well know. So what happened to the iPhone 6? It was launched on the 25th of September, or rather went on sale on the 25th of September. And during that weekend, they sold 13 million of these new iPhone 6S phones. That beats any other pre-launch weekend by 30%. The best previous to this was the 10 million of the iPhone 6, which was a year ago. The iPhone 6S since then appears to have gone well. We've heard nothing more from the company, which is to be understood because you have quarterly results coming out. Remember, the September quarter is now behind us, so they'll be putting their figures together and wouldn't want to let anybody have any insiders taking advantage of this. But I've got a feeling that when their numbers come out at the end of this month, that Apple will show that the company continues to flourish. And indeed, when we get to the next quarterly results, they will include for the most part, the sales of the iPhone 6S. It went on sale this month in India, Russia, Saudi, and Turkey and markets like that. You can buy them now in South Africa. And when you look at the 6S and you compare it with the 6, how big an upgrade is it? According to the techies, significant. It's much faster. But the techies say that's not really what you need to look at. Rather, it's to consider, will people upgrade from the Apple iPhone 5 to the 6S? And there's a huge jump, apparently. The Apple 5 came out 3 years ago, and you can imagine with a company that's spending enormous amounts, as Apple does, on research and development, that when it comes to producing a new product, and such an important new product like this, it would make sure that all of those bells and whistles would be included. They spent last year, incidentally, $6 billion on R&D. That's about 3% of Apple's sales. That should be sufficient to encourage those of us who have Apple iPhone 5s, and I'm in that group, to upgrade to a 6S. If not, when your contract expires with the service provider, then perhaps even go in there before. The 6S Plus, which is the big screen, has been sold out, and you cannot get stock anywhere in the world of that for several weeks into the future. So has Apple defied its critics? Chief Executive Tim Cook reckons it has. He says that they've done far better than the analysts were projecting, but we will only see whether the market reacts to that when the quarterly results come out, and as I say, they will be in the next few weeks. So stick with the Apple shares. We've continued with that bet, and we're very happy that we're getting in at a level now which is going to look pretty cheap into the future. Just to close off with, here is the look of the portfolio today as against where we began on the 5th of December. When we took that view that it was time to take money offshore, as you can see, the Rand dollar then was 11 Rand 27. It's now 13 Rand 51. So just sitting still. Just if you'd taken your money offshore and put it into an account over there, you would be 20% up. Incredible. As far as our portfolio is concerned, we've outperformed the market by 8% in US dollar terms. The market as a whole is down 3. We're up 5 at this stage, and that has given this portfolio an annualized return of 29%, an overall return of 25%. And the star performers there, Amazon, Google, and Novo Nordisk, This is in rand terms. Wonderful returns that we've enjoyed in this past year. Vanguard, which is the overall index, as you can see, it's down just around 3% when you round these things off. The rand losing 20%. Vanguard still is 16% up in rand terms, and even IBM and Berkshire, which have been underperformers on the US market, are better off. Apple being our sole loser at this point. That's incredible, actually, because when you're buying into a portfolio, you've got to expect that some of the shares you're going to be able to accumulate at a price that is going to be lower, or rather that a price that you just can't time these things perfectly. But that's our seminar for today. Stuart, I don't know, questions?
Yeah, a bit dry on the question front. Okay. Can't blame the heat wave in Johannesburg, but it could be a factor.
Well, there are about 55 people who are listening. So if you do have questions and you got something wrong with your computer and you haven't been able to send them through, or if there's something wrong with our technology on this side, which is always possible, we would ask you to perhaps just email them. Email to alec@biznews.com, alec@biznews.com, and I'll be able to respond to that as well. So that's our story for this week. We look forward to being with you at the end of the month. I'll give you a little bit more notice on that one. Put it through the newsletter, etc. And hope you'll join us then, and hope you are enjoying the performance of this portfolio.
Yeah, thanks, Alec.
All right, well, that's it. We look forward to seeing you then in the end of October. Cheerio for now.
Cheers.